Welcome today to the RaaS Research Group Stock Take webinar, where we will dive deep into the analysis of a promising ASX-listed stock. Today, we're focusing our attention on Pureprofile, ASX code PPL, a data analytics and consumer insights company underpinned by proprietary technology, servicing business decision makers in brands and media companies, as well as market researchers. RaaS Research Group's detailed analysis will be presented by Senior Analyst Finola Burke, who will cover all the main themes, financial models, and potential pitfalls any scrupulous investor should consider before making an investment decision. Finola has recently issued research on the company, detailed research in fact, and I urge you to read it while looking through the presentation. We will be sending you a copy, so take the time to take it in. The presentation from Finola will then be followed by Pureprofile CEO Martin Filz and COO Melinda Sheppard, who will provide detailed overview of the company, its recent successes and future plans. After their presentation, we will have a live Q&A session. Please feel free to submit your questions using the Q&A function on your screen at any point throughout today's webinar. I'll be collecting these questions and putting them directly to our presenters during the Q&A segment. This is your chance to look under the hood, to ask the questions you want to ask to management and to Finola. Thanks for joining us, and without further ado, let's get started. Please join me in welcoming RaaS Research Group Senior Analyst Finola Burke.
Hello, thanks David. And thank you to the TechInvest team for hosting our presentation today. Dave, if we could move through to slide 3, please. So I'm just going to briefly take you through the agenda for the day. We're going to look at the FY24 result, which the company recently reported. We'll go through our expectations for outlook and forecasts. We'll look at the peer group that we apply against Pureprofile. And we'll also have a deeper dive into the one we think is most like Pureprofile, being YouGov. We'll discuss our evaluation approach and look at some of the key sensitivities and risks in our forecasts. Next slide, please. So on to the FY24 results. The result, we thought it was a good result in a challenging environment. The overall sales were up 10%, ANZ up 2%, rest of the world up 23%, which we thought was a good result. Really, it was a lot of it, the growth was being driven by the platform revenue, which is across the group, and that was up 88% across the group, and probably tracking just very largely in line with our expectations. EBITDA was impacted by the move to cash-based STIs. So excluding that impact, we would have seen EBITDA increase by 8%, and that margin would have been more like just over 10%, so it would have been flat. Another point I'd like to make is that the compound growth in revenues generated by the company over the past 3 years has been particularly driven by a platform, the self-service offering across all geographic regions. That was up 102% CAGR since 2021. So next slide, please. So why is platform important? Well, we think it's been a key driver in gross margin improvement in the group, and an underlying driver in the EBITDA margin improvement. So looking at this table, these are some of the measures that we like to look at post results, and to test the quality of the results. So some of those key measures we look at are things like return on invested capital, which we like to see at least percent and growing. So good, strong assets, current assets against liabilities, and EBITDA to operating cash flow, which we like to see at least at 90% and above. So you can see over the past 3 years, those measures have improved or remained at healthy levels within Pureprofile. We'd expect benefit of investment in people and AI in gross margin and EBITDA margin going forward. And the flow through is our expectation that these measures will also improve. Next slide, please. So looking at the peer group, we look to a lot of the international peers, and these are the companies that Pureprofile is actually competing with in the European and Asian markets. And what we've done here is we've looked at their performance over the last 6 months of the financial year, so the second half. The one thing I'll point out to you is YouGov reports on a August to January basis, so they actually and January to July basis. So we haven't seen results from them as yet. So we've just as a proxy used the August to January results. Comparing that performance, so we can see that on an overall revenue basis, both on quarter and half, Pureprofile has outperformed its peer group quite well. On an EBITDA basis, it has underperformed. If we were to strip out that impact of the cash STI, you're looking at EBITDA growth of up around 8%. We estimate around 8%, which is probably more in line with the peers, although a little below. So next slide, please. Comparing the company to the peers on an EV to revenue and EV to EBITDA basis, the company's trading at a substantial discount to those peers. So on an EV to revenue basis, it's at a 255% discount to the median, and on an EV to revenue basis, it's on a 38% discount. We'd expect to see that gap narrow as the margin traces up towards that median of 17.9%. So you can see there, we do think that margin at that discount is really due to the margin. We expect as margin improves, and we are expecting that margin improvement, that gap will narrow. So next slide, please. The one we'd like to look at particularly is YouGov. This business is a pure consumer insights and data analytics play. So we do think that is the most comparable to Pureprofile in terms of business model. Now, it's useful to look at this business over time. They're a much larger business today. They're over 500 million market cap. But if we go back and look at back to 2009, and I'm sorry if it's a little bit small there, but if you go back and look at to 2009, the company that YouGov was generating revenues around that 40 to 50 million pound mark. The EBITDA margin was around the 9% mark. Sound familiar? It's very like where Pureprofile is today, and the market cap at that time was around 50 million pounds. We've seen since that time that YouGov has remarkably improved their margin. So their margin has been up around that, up to as high as 30%, it's tracking in the mid 20% at the moment. And analyst expectations are though for it to improve over the next couple of years, and revenue has grown strongly as well. So when we came to model Pureprofile, we looked at these examples and went, well, we think the company can do something similar. So moving on to the next slide. I'm not necessarily saying that Pureprofile is going to get the same sort of market cap, but we do think that growth profile can be achieved. We've got a CAGR of revenue growth of 10.8% out to 2034. Our 10-year CAGR for EBITDA is 25%, and we expect that the annual margin growth to grow at a CAGR of 13% over the next 10 years. That compare that to YouGov, they've got a 13% CAGR over 25 years in revenue, and a 22% CAGR for EBITDA. Next slide, please. So how is that going to be achieved? Well, we see platform as being a key driver in our forecasts. So we're forecasting that platform revenue will grow at a CAGR of 18% from 2024 through to 2034. It already has grown very strongly, but we do think that growth is going to continue. This is across platforms, it's across the group. We expect as a percentage of total revenue for platform to grow from 19% in FY24 to 36% in FY34. And those margins, we because of the self-service nature of the business, we do see those margins. We we estimate those margins are much higher, more like a SaaS model of around that 85% mark. That's our estimate, of course. And we do think that will help underpin margin growth longer term within the group. Next slide, please. Just looking at our valuation, we prefer to use the DCF method of valuation, given that this company is sort of at an earlier stage. So we're using a discount rate of 13.3%. That includes a beta of 1.43. The LSEG observed beta is a bit lower now at 1.32. If we were to apply that, we're getting a 10-cent valuation on a fully diluted basis. Our valuation implies an EV to revenue multiple of 2.8 times on FY24 actual and 2.6 times on FY25. Now, that compares with current multiples of 0.6 times FY24 and 0.5 times FY25. Now, compare that to YouGov, which is trading on 4 times their last reported sales. So we do think there is that is a justifiable valuation. We do a 10% plus or minus sensitivity analysis in our base case forecast, so that derives a range of 6 cents to 12 cents a share. Next slide, please. So the key sensitivities and risks that we see within our forecasts are obviously the growth rates we use for the data and insights business. Now, excluding platform, our forecast is for a 10-year CAGR of 3.9% in the Australian and New Zealand business. And then our growth forecast for rest of world is for a 10-year CAGR of 12.9%. That's again excluding platform revenue. Platform revenue we have growing at a CAGR of 18.5%. We think the EBITDA margin can go from around that 10% mark to 20% in the next 4 years, and we have it growing as high as the low 30s over 10 years, and that being driven by the platform business. We expect costs. So costs again, is a risk. It can be a risk factor. We've got it growing at 6% compound. Again, if we're too low on the mark, that will have an impact on our forecasts. We do think, though, that the company is investing in increasing automation and using AI. That could drive down costs further. I would expect it to do so. And our valuation is also sensitive to the discount rate that we use. We do look to lower that rate on maintained evidence of sustainable profitability. And that's it from me. Thank you for the opportunity to speak.
Thanks, Finola. A detailed analysis, and I think it really sets the scene for the full Pureprofile presentation coming up. Remember, a copy of the recently released research on Pureprofile can be found on the RaaS Research Group website, and I urge you to go download the research, have a read, and get an understanding from an analyst point of view on their view on the company. Now, it's time to hear directly from Pureprofile CEO Martin Filz and COO Melinda Sheppard. Please join me in welcoming Martin and Melinda, who will now present on the company.
Thank you very much, David, and thank you very much, Finola, also for the introduction. Funnily enough, one of the things that absolutely attracted me to Pureprofile 4.5 years ago now was I'd headed up regionally two of the largest competitors in our space, and I took a look at Pureprofile and realized that sitting within the business was this fantastic data and insights company that had been established for 24 years, that was already operating in 5 countries and was being used as the sort of the cash cow for the rest of the business and these other ideas that weren't quite working. And along with the board at the time and fantastic supporting shareholders, we were able to do the debt to equity swap with Mel and the team, divest the business of assets that weren't necessary to being a data and insights company. And then the journey really began 4.5 years ago. And I'll talk about that a little bit, but we've seen revenues double. We're now in 13 countries. We're now profitable, and we absolutely are on that similar path and similar journey to YouGov. So it was a good example to have, and that was, as I said, one of the reasons I was attracted to the business 4.5 years ago. So with that said, we'll jump into Pureprofile today. Thank you, David. All right, so business overview, if we can jump to the next slide. So who we are, look, we're a B2B company. So we work with organizations who basically are looking for answers to their business questions. They want to understand their audiences more, and that might be consumers who already buy their products, consumers who are looking to buy or buy competitive products, could be government work, so the voters, non-voters, supporters thinking of new schemes, could be companies that are looking to launch new products, automotive company or whatever, but basically they're looking for answers. So we connect the right audiences with the right business and deliver the right answers to those questions. 70% of our business is based on surveys. And so we have millions of people around the world that we're able to ask questions to relevant to organizations. And then 30% of our business is actually analyzing data from, again, millions of people around the world. And companies can go straight in some of our SaaS products and DIY products to look at consumer spend or sentiment or activity to, again, get answers. And then maybe they might deep dive to do a survey afterwards. We do that because every product that's fitted to a consumer, every business that actually puts their consumers first is going to be more successful. And so by being able to provide that complete audience insights, we can help businesses make better decisions, new products, advertising, messages, etc. Thank you, David. We've had this strategy for 4.5 years, and it's the key strategy for us as the business. Number one was to be truly global. At the time, 75+% of our business was based out of Australia. It was an Australian-centric company, and I'd never worked for an organization before where Australia was the number one market. And so firstly, we set about creating truly a global business. And although, as I said, we're in 5 countries at the time, what does that mean? It means that whether I'm a customer or a team member, and whether I'm sitting in London or Amsterdam or Munich or Singapore or wherever, I have exactly the same experience as somebody that's sitting in Australia. Those tools are available and specific in multi-language tools. The support systems that we have are follow the sun through 24 hours, the processes that we follow, etc. And only then are we a true global company. And so we've spent much of the first 12 months of that 4.5-year journey and creating a truly global company. And today, approximately 47% of our revenue is global revenue, and about 53% is Australian-centric revenue. So we're leaning in and certainly delivering in that journey. The second goal was to actually look at self-service and look at platform. Finola called that out, and today approximately 20% of our revenue comes from platform or comes from self-service, comes from automation, and that was 0 4.5 years ago. So that connectivity directly to our clients who would be able to go into our data or to launch surveys, to bypass working with our team, so we're able to deliver faster, we're able to deliver cheaper and to the same high quality through our platform revenue. So that technology platform has been a focus. And interestingly enough, it's not just external technology. So actually being innovative as a company, you are rolling out in new internal systems, improving better ways of working. Finola talked about margin expansion. And then also that same technology is able to be utilized by clients. And then the third part of that strategy is absolutely doubling down and focusing us as a business, as a data and insights business, and being seen as experts and specialists in that space. And certainly we have a fantastic global awareness of our business. And we're one of only 5 companies, and Finola mentioned YouGov, that are truly Northern and Southern Hemisphere companies, both with offices and with clients. So we're very proud of that. And that, again, has been a key focus for us over the last 4.5 years. Thank you, David. As I said, we have offices in 13 countries. We have 800 clients globally, over 220 staff. We actually made a little acquisition, so that's over 230 staff. I'll talk about that in a moment. We finished the year 48.1 million of revenue. In actual fact, for the first time in the history of the company, we were NPAT profitable, so truly bottom line profitable. And that was, again, a focus that both Mel and I have had in the business. When we first started working together, Mel's been with the company about 6 years. When we first started working together, the first goal was to be operating cash flow positive. And we were that within a couple of quarters of the new strategy, me joining a new strategy. And then the next goal was being NPAT profitable. And I think Mel talks about the first year she joined, I think the losses in the company were over 14 million. In financial year 23, there are approximately 2.2 million of losses. So to turn that true NPAT profitability whilst having the same, being a growth company and having that double-digit growth trajectory as a business has been something we've focused on and very proud of. 91% of our customers are repeat customers. So, and this is one of the reasons we're having such traction globally, is that high quality of delivery for organizations and standing out from competitors and really helping organizations confidently make those multi-million-dollar decisions that they make. And then, as I said, $10.4 million today in annuity revenue, and that includes platform revenue. And that, as I said, is a focus and enables us as an organization to be profitable, to have margin expansion, and to also be predictable as a company moving forward. So we can say 20% of our revenue is in the bag as we start July the 1st. Thank you very much, David. So in a little bit more detail, what we do and where we plan to be in 25. So on the right-hand side, we have audiences. And those audiences, as I said, provide us with the ability to go out and do surveys. We had close to 20 million survey starts in financial year 24. So it enables us to go out and do surveys. And those audiences are made up by our own panels or audiences that we recruit. We have a very clever tool called Audience Builder that enables us to directly link into companies' loyalty schemes. And in Australia, partners such as Flybuys, News Corp, RaaS, New Zealand, companies such as Horizon. We have our first partner in the UK called Sprive, which is an ulterior banking solution. And that enables us to build audiences really quickly, build unique audiences, large size audiences. They're highly loyal because they're already tied in with another scheme and very high quality. And then we do a back-end revenue share. So it enables us to really get quick traction in new markets or new segments in the market. And then if we are unable to find maybe a client wants 1,000 BMW drivers in Manchester in the UK, and within our own panels, we might have 750 of them. We might have another couple of hundred within our audience builder partner. And then those final 50, we go out into our partner panel network that, again, we have direct links into their systems that go straight from our technology. So we build our own audiences. We then, with the advent of AI, and I'll talk about AI a little bit later, we're starting to experiment with synthetic data. So this is the opportunity of creating virtual audiences who mimic real life audiences, and clients can come in and ask questions to this virtual audience, and again be able to get really fast results. It can be cheaper to get those results, but it's still of a very high quality. So that's really useful for maybe idea work or pre-concept work that then they want to eliminate certain choices. They can go to that virtual audience and then deep dive further to our survey data or survey audiences or that data from our audiences. So we're just starting to play with synthetic data, and the idea is that or the goal is we grow to about 50 million global panelists and audiences around the world. Then the next column where we've got APIs and direct services, so that's where clients connect in two different ways to those audiences, either direct through our DIY systems or direct from their computer systems through APIs, and that's that $10 million, that 20% of our revenue, or through managed services, through direct services. And we have about 115 people in India and the Philippines, where if clients come to us and want us to actually run that project for us and create that for them and create that project for them, and then to launch it and then to deliver results, we do that through our offshore teams that we've built. In the middle is our own proprietary technology platform that we've built and continue to invest in, that gives us some unique deliverables over competitors. And one of the reasons that clients keep, or some of the reasons that clients keep coming back to us. So it's again the ease of use, the speed of use, the high quality of data that we deliver, and that's for both clients and then our internal teams being able to work efficiently. And then on the left-hand side, again, clients accessing the data, they're going through APIs, going through direct services. In this financial year, we're starting to roll out some of our AI technology to clients. We've already done a number of AI solutions internally. And actually, our first AI solution we launched at a major event in Australia about 3 weeks ago, which is bringing together a type of research called qualitative research and quantitative research, and all through video actions. So rather than respondents typing out their survey replies, we're actually the first company to be able to launch high volume and high scale video responses. And that's 3 weeks now, and we've had great reaction from clients and from partners, and then starting to roll that out globally as well. So that's our first AI facing solution, which is this video solution. And then clients can access this through managed services. So going to the group in India and Philippines I talked about, Insights Builder, which is our DIY tool, survey tool, audience intelligence, where clients can go into and access consumer spend of their target audience or competitive target audience to understand, for example, who went to Bing Lee yesterday, how much did they spend? Who went to JB Hi-Fi, how much did they spend? Where did they come from? What were their postcodes? What were their profiles, etc. So they can understand, how can I maybe win some of those clients or win more of those clients if I'm the incumbent business. And then rolling out qualitative solutions. That's a brand new revenue stream for us. We've traditionally been a quantitative company, so that's en masse. Qualitative is deep dive of insights and research. So we're rolling that out. We've rolled out a partnership with an Australian company called Lonergan. So that's offering our clients being able to do qualitative research. And then this video solution is the absolute marriage together of quantitative and qualitative research. So very excited about that. AI activated insights links with that synthetic data. And in Q2 of this year, we will have our early quarter two actually, we'll have our first release of synthetic data and AI activated insights for our clients. And then looking at bringing to those 800 clients that we have, being able to upsell them to other solutions. So thinking about as we roll out direct to brand solutions such as ad effectiveness, how successful are your ads? Do we predict they're going to be? How successful have they been? So that clients can have more of an impact in the advertising space. And then also such things as brand tracking to understand how's my brand doing? How am I doing compared to my competitors? How do I improve my perception among my audiences? So a few new solutions coming out, few we already launched in quarter one, and a lot of automation around our tools and our platform. Next slide, David. So I talked about that a little bit at the beginning. So 2020, we had a company restructure. So we restructured the group operations, focused on being that data and insights company, did a debt to equity swap. I refreshed the executive team. About half the executive team is new, half was existing within Pureprofile, and really giving us a strong platform to grow from. Financial year 20 to 23, it was really about, as I said, becoming a global company, realizing what we do well in Australia, what makes us market leader in Australia, and then exporting those skills, the same messages, same delivery for clients, making sure we have true global processes, re-engineering our core technology, modernizing our core technology, making it more open, more accessible for clients. Whilst we use the phrase, and I've used this before, where it's a little bit like changing the wheel whilst the car's still moving. And that was financial year 20 to 23 for us. It was refreshing everything inside whilst having also this stellar growth as an organisation. And then financial year 24 through to 26. Is really focusing on increasing those revenues, increasing margin expansion. Now that we're profitable, growing on that first maiden profitability and being a truly cash generative organization, leaning into where we have really low market share globally, but those markets are much bigger than the Australian markets. Rolling out AI tools for both internal and external efficiencies. And it's interesting about AI. We were in a executive team meeting, it's a good few months ago now, and our CTO said about 15 minutes in, okay, everybody, just stop talking about AI. We have client opportunities or problems we want to solve. We have business opportunities or problems we want to solve. And let's talk about those. And then in some instances, AI is the right solution. And what we've seen across all industries is the advent of AI has really made organizations become more innovative and more focused on how can I do things faster, how can I do things cheaper, and how can I do things at a higher quality. And those are the three areas that we look at for any type of development that we do. Are we meeting one or at least all three of those criteria before we roll out a new solution internally or externally? And then moving forward, it's absolutely to continue to innovate through our technology with industry leading first, like the video tool that we just launched 3 weeks ago. And also potentially start looking at acquisitions. We made our first acquisition at the very tail end of financial year 24. We purchased a company called iLink. I'll talk about that in a moment. And that was our first foray into acquisitions. And that's gone incredibly well, great integration, growth within that company and within our business straight away on the back of those. And has brought some innovation, fresh thinking, etc., to both organizations. So, and start to identify, maybe execute more acquisitions where we can see that can give us a real step change in new markets such as UK and US, which we see as absolute growth for us. Next slide, please, David. Why are we so worried about being global on the left-hand side? Well, it's because Australia in the data and insight space is about a $2.4 billion market, US dollar this is. So about 2.4 billion, so about 2% of this total 130 billion US dollar market, which is data and insights. The addressable space for us is about 20% of that market, and that's common across all geographies. But if you look at the UK, where we've been for close to 10 years now, the UK $11 billion market, it's 6 times bigger than the Australian market. It's doing exactly the same thing. It's some of the same clients who are global clients require the same deliverables, require the same answers to those same business questions. Our type of business and the way we operate is identical to that we operate in Australia, and so it's a 6 times bigger market. And then the US market is actually nearly approximately a 27 to 30 times bigger market. Again, same language, doing exactly the same thing, and it's the same business structure for us as a business. So that's why it's very key for us to lean into this globally, and why we're seeing such rapid growth globally, far outstripping ANZ, is because those are far, far bigger markets that we're moving into. And then on the right-hand side, just a little table there talking about AI and the importance of AI, and some of the things that we've seen, internally, margin expansion that we've seen is from rolling out things like all of our translations now are delivered in AI tools. We did research in the last 12 months in 90 countries. And so we would previously have gone out to third parties for translation, for perhaps surveys or data, or even launching new countries for ourselves. And that would cost us money and would take time. Now we do that all through AI tools, and we've written our own applications on top of some AI translation tools. And those translations happen instantaneously. So we're able to deliver to those clients immediately at zero cost, because we don't need to go out to an agency. As an example for internal. Synthetic data, as I said, our first release will be early into Q2, being able to offer something directly to clients faster, cheaper, still high quality. AI clients, there are over, I saw a slide the other day, there are over 2,000 clients, AI companies that are launched in our space. 98% of those will fail. And the reason 98% will fail is standard business rules, the cash flow, the client growth, running out of funds, etc. The second thing is many of those have been developed trying to find a problem to solve. They've built a solution and trying to find a problem to solve. So that's going to cause failures. The other thing that they all have in common is none of them have proprietary data. None of them have audiences like we have, millions of audiences, people around the world generating data that are needed to power these systems. So AI companies become another revenue source and another source of client base for us at Pureprofile. AI gives us automation, it gives us real-time delivery of solutions. So everything in our organization becomes much faster, it gives us cost savings. I talked about that as an example of AI translation, and it gives us innovation. We're thinking much more innovatively as a company. And again, that journey that we're on, financial year 20 to 24, where we were thinking, or 23, where we were doing a lot of work on our internal systems, we're now at the position where within that same capital investment, same size team, we're able to divert that team to start looking at innovation and external client-facing solutions. Next slide, David. So why do we do that? As I said, it's because companies that are successful in the US and the UK are much larger than Pureprofile. Finola gave an example earlier. Typically, they're between 150 AUD and 1 billion AUD in revenue, and that is because they have successful and large US and UK businesses. So that's an absolute focus for us now as an organisation. First, the UK to grow out, where, as I said, we've been for 10 years. We have about 17, 18 people. We have a strong brand presence, strong client base, and now it's really to leverage that and to accelerate from that platform. So what have we been doing? Well, we've trebled the size, of our business in the UK over the last 4 years. We've trebled the size of our US business. We still do that remotely. We don't have boots on the ground at the moment in the US. That will be the next step, but one thing at a time. Let's build out that UK business first, and then let's look at financial year 26, 27 to have boots on the ground and really accelerate that US base. But we don't want to be stretched too thinly. We want to keep growing at that top line, strong double-digit numbers, whilst also growing that bottom line NPAT profitability. And as Finola also talked about, we've grown that platform revenue to 20%. It's also about growing that out, about growing that automation, that direct to client solution. We also see a few tailwinds in our industry. Firstly, there's data quality issues because so many companies don't have access to their own audiences like we do. They're relying on third-party audiences where the data quality isn't as good. So we don't have that problem. We're renowned in our industry as being absolute high quality. Some of the peer groups are challenged in our space. When the share prices were high, financial year 21, many of them made very expensive acquisitions, which included debt within those as well. So many of those can't get away from high-priced acquisitions that they've made, and now debt is more expensive, having, as we all know, gone from 0.5% to over 5% in the markets. So we're able to lean into where they're not able to invest, not growing, and actually Pureprofile is doing the opposite, is growing and investing. So we're winning that market share. Attracting great people, again, a key focus of myself, Mel, and the whole team is the culture within Pureprofile. We've won numerous awards globally for being an innovative workplace. And the key thing there is absolutely having the right people in the right roles, giving them the right tools, and then getting out the way. And clients want to buy from proactive, motivated, consultative team members, and that's absolutely working for us. And then, as I said, the last one is the rise of AI. It's adding clients, adding efficiencies, it's adding new client solutions. We couldn't have launched that video solution, which we launched 3 weeks ago, without AI being a part of it. And it means that we can do much faster development and faster innovation. Thank you, David. So achievements in 24, really proud of the whole team and our maiden full year net profit of only 0.1 million, but that was after a net loss previous year of 1.9 million. We successfully achieved our full year financial guidance of 48.1 million in revenue, 4.4 million EBITDA, and a 5.2 million cash balance. And in actual fact, every year we tend to give guidance out at our AGM. AGM will be in October, and every year we've met or exceeded our financial guidance. So really pleased with that. Rest of the world revenue, 43% of our total revenue now, up from 38.5% and as low as 25% 4 years ago. So that's been a key focus. Talked about repeat clients. 5 new AI solutions that we've rolled out about internal efficiencies. This actually can be slightly updated, 6 now, including our client one. We rolled out offices in Spain and Germany in financial year 24. Again, we've got global clients, so that's clients requesting it, and 2, us exporting that expertise that we have in Australia. We won an inaugural award, which was from Research Partner of the Year by the Research Society in Australia. So that's voted on by clients in our space. So that was a great accolade. And then we've been named in the top 50 inspiring workplaces in the UK, fourth in Asia. It was top 5, I think, in Australia. And actually, I can't remember the exact place now, but we were, Mel might be able to help.
I think it's 88.
88. So we were 88 globally. So out of every company that entered it, we were 88. So that's again talks testament about the amazing teams that we have and why we have 91% repeat revenue from clients. Next slide. Thank you, Dave. We made an acquisition of iLink, which we completed 1st of July. So we paid a total of 1.25 million for that business, paid in 2 tranches at the beginning of the year and then another one in 9 months later. They were established in 2001, approximately 2.7 million in revenue, 17 fantastic people, both onshore and offshore, delivered over 1 million surveys to over 50 clients. And there are fantastic synergies of the 2 businesses coming together. We're able to use their data. Suddenly all of the bottlenecks they had of maybe not having enough resources or not having enough survey respondents or data for their clients to answer questions has now evaporated overnight. So they can do more with their existing clients and more with new clients. And then we've got synergies moving everybody into single office, ways of working, migrating everybody to Pureprofile systems, whilst also learning from some fantastic people that have come across in that organization that help upskill us and make us better as a company as well. So really, really pleased with that acquisition and how that's gone. And it's flown by. It's now 3 months since we made that acquisition, but that's really done everything that we wanted it to do. Next slide. We also had some board changes at the beginning of the year. So we got a fantastic new chair, Michael Anderson. He took oOh!media from pre-IPO through to IPO and was chair of oOh!media, as well as a number of leading media organizations sitting on their boards, etc. And it really fantastic insights into different industries, different ways that businesses operate. And it's a great partnership that him and I already have just in a few months. Adrian Gonzalez, so pleased he agreed to join our board as well. He comes from, he's an absolute growth leader. He comes from an organization called Kantar, which in our space is the 2nd largest data and insights company. He managed over 20,000 employees throughout Asia Pacific and in a $1 billion organization. So again, challenges myself, challenges the executive team, has a fantastic Rolodex, introductions, new ideas, new solutions. So really fantastic to be able to welcome Michael and Adrian. We've got a fantastic board now that really mirrors the executive team and that growth identity, that international experience and that strong business acumen that we need from a board. So really, really pleased with that. Thanks, David. Now, I've painted a picture of an amazing company that I'm so proud to work with, that is so exciting to work with. And this table shows, but the share price has gone the other way. So as you can see, as we've grown as an organization from that sort of circa quarterly revenue, Q1, just over 5 million, to Q4 financial year 24 over 13 million, and the share price has gone the other way during that. And so we work with an excellent IR company called the IR department. We have fantastic funds who are really supportive of us as a business. And now it's important for us as a company to really get out there and to identify new funds, new shareholders, do more work, such as talking on podcasts such as this, and really to spread that story of what an amazing organization we have in Pureprofile. And certainly we've seen great response to hitting that first NPAT profitability and still being a growth company. And as small cap markets start to come back and investment starts to come back, and that Pureprofile really starting to stand out on its own. Great Australian story, global expansion, strong growth, margin expansion, and NPAT profitability. So it's our job to really spread that word and increase the demand in the business. Thank you, David. And now I think you've all had enough of me, so I'm going to pass over to Mel for a bit. Thank you.
Thank you, Martin. If you can go to the next slide, please. I just want to let everyone know that these numbers are now audited. So whilst the slide says that they're unaudited, they have been audited since this deck was created. And the numbers predominantly focus on our continuing business only. So they exclude our discontinued media business that we divested of in the first quarter of FY24. So as Martin said, very proud that we had our first maiden profit during FY24. To give you context of where we've come from, in FY20, the year before our recap and our debt restructure, we made a statutory loss of just under $10 million. So consistently since FY20, we have grown our top line from a double-digit perspective, and we've continued to grow not only our EBITDA, but also our statutory, move from a statutory loss to a statutory profit perspective. So how have we done this? Well, we've actually got this really disciplined investment approach that Martin and I have been focused on since that period of time. So every time that we look at what we're going to invest in, it needs to have a positive ROI over a period of time. We invest small, prove out a concept, and then we will put more money into it. And that philosophy has really been really positive for us, and that's why we've consistently grown top and bottom line. The investment philosophy over the last 4 years has also been focused on growing outside of Australia. Martin talked about Australia, we're market leader. We've continued to take market share in Australia, but Australia is obviously a small market. The opportunity is outside of Australia in the UK and the US. So our investment has really been focused in those areas. And that's why during FY24, that the rest of the world revenue growth was up 23%, whilst ANZ was only 2%. ANZ did have a challenging financial year during FY24. If we had seen that growth consistent with prior years, it would have been closer up to around about 10%, which would have bolstered the whole year-on-year growth for the entire group. EBITDA was 4.4 million, which was down, and that was predominantly, as Finola signalled in her section, we did have a change in our remuneration strategy during FY24. In prior years, all the incentives for our executive team were equity-based incentives. So they fall in the P&L under share-based payments, which sit below EBITDA. If we adjusted and did a like-for-like perspective for FY24, we would have actually written EBITDA of 5 million compared to the prior year of 4.3 million. And that would have been up 8% on the prior year with a margin consistent with the prior year. But the business now is in a really strong position from a cash flow perspective. And, you know, we believe that the right way to incentivise now is to make the STI cash-based so that we don't have that dilutive impact on our shareholders. Our reported cash balance was 5.2 million, which was a really strong result. Our operating cash flow during the year was $3.5 million, and that was up 2.6 in FY23. During the financial year of FY24, we refinanced our debt facility. That was $3 million back in December FY23. During the financial year since we've refinanced, we've repaid 100,000 of that debt. And positively also, at the end of last financial year, the cash balance was 4.7 million. So you can see that strong uplift during the financial year. During the financial year, we had restructuring costs related to shutting down our media business. We also had transaction costs related to the debt refinancing, termination fee, but we still had a really positive, strong operating cash flow. And as Martin said, when he started off his presentation, he talked about our two key financial milestones have always been cash flow. We've always wanted to ensure that we had sufficient cash flow to continue to grow the business under our growth strategy, and not need to ever raise capital to keep the lights on. If we ever wanted to raise capital, it would be to do strategic acquisitions that would really help us move into new markets. So that's been really important also. When we talk about our investment philosophy, during FY24, we did invest in the business, and we invested outside of Australia. We did it across 3 key functions. The first was headcount. So we've hired roles in Southeast Asia, in Europe. As Martin said, we opened a German and Portugal office. And when we open new offices, we do it very light touch, low cost, and we prove out that market. And once we've proved out that market can be profitable, we will then put more money into that market. So we have a real, I suppose, template for how we go into new markets from that perspective. We invested in new sales capability and operations. When we think about our investment, it's always got to be growing the top line revenue or making us more efficient so that we can get that margin expansion over time. We also invested from a marketing perspective. We're really trying to grow our brand awareness outside of Australia. We've got very strong brand awareness in Australia. As Martin said, the market's huge outside of Australia. So attending conferences, making sure that we are out there with our peers and we're becoming well known. And those conferences that we are sponsoring and attending, they actually bring an amazingly positive ROI. We always pick up a lot of new business, new clients when we attend those. So that's really positive. We also invested in technology, and predominantly one of the key things that we did during FY24, we got our international IT standard accreditation, ISO accreditation 27001. That was for 2 reasons. Obviously, cybersecurity and privacy is really critical, particularly for a business of our nature. But there was also a commercial imperative for us to do that. A lot of government clients and a lot of multinationals now require you to have those accreditations. So they know that their data's safe with us from that perspective. So we did that during the year, and that's been a really positive thing for us to do from the business. Just another thing just on FY24, our capital expenditure. So we have capital expenditure on R&D, so product development, software development was about 2.2 million. It's been over the last 4 years pretty consistently between $2 to $2.4 million. It was $2.2 million in FY24. Now that CapEx really relates to a lot of the investments that we made in the AI tools that Martin talked about. We're also developing a solution which is really a specialised application for our partners and our internal resources called the Hub. We've done multiple API integrations with partners and optimizations, a lot of platform enhancements, and we've done a lot of new audience builder integrations as well. So we also have a very disciplined approach to CapEx, needs to have a positive return, and again, very test and trial and make sure that we are going down the right route before we spend a lot of money on anything. And again, as I said, that has really been part of that consistent growth that you've seen over time. If you just go to the next slide, please. So you can just see here, again, our consistent approach has delivered this consistent growth of strong CAGR over 3 years. You can see the ANZ revenue, again, very high, a large portion of the revenue, but you can see that how quickly the rest of the world's catching up. From that perspective, we talked a lot about the platform revenue, and Finola talked about it too, how that's been driving our overall revenue growth. And then our EBITDA growth has been very consistent as well. And the only reason it was down in FY24 was that change in the short-term incentive from equity-based to cash-based. Go to the next slide, please. So I won't talk too much about this, but during we had a really lumpy financial year during FY24. Particularly Q2 for us was a particularly challenging quarter. Our ANZ business was down actually during that quarter. And then what we saw as we went into the second half of FY24, a really strong recovery in ANZ. So we really focused, once we saw a challenging quarter, of all the different levers that we could pull to really help make sure that we could recover that revenue going from Q3 to Q4. So I just wanted to share with you that Q4 was really a really strong quarter compared to where we were for the rest of the year. And going into, Q1 of FY24 looks relatively consistent with this. So we did have record revenue for that final quarter of the year of 13.1 million. Q4 is always our strongest seasonal quarter too, and that was up 18%. And if you look at Q3, the group revenue growth of 6%. So that really just does demonstrate to you the momentum that we had over in that final quarter of the year. And just quickly, EBITDA actually was up, even if you include the impact of the cash-based incentive for Q4, because it was such a strong revenue quarter. We typically have the strongest margin for Q4 as well, because we've made our investments at the start of the year typically. Next slide, please. And again, the trends for Q4 very consistent as to what you see for the full year. And I suppose that's the key point we want to communicate to you as well, is that it's consistent growth, consistent results. Delivering on the guidance that we give the market is incredibly important to Martin and I, so that we can give our shareholders and future shareholders trust that we will deliver on what we say we are going to. And I think that next slide. So just our key priorities for FY25 will continue to be international expansion. We will continue to grow our commercial team in the UK. We have a really amazing opportunity there. We've already hired a few new team members in FY25 already to help continue that growth. We'll ensure that we've got the right support for the German and the Spanish businesses. ANZ, we just want to continue to build on the momentum that we had in Q4, and making sure that part of the business that can continue to grow during 2025. The iLink acquisition, so that completed on the 1st of July. We've integrated that already. In fact, actually, the integration was really quick. It's a business that was really well known to us. The culture is very consistent, so it's been very smooth and easy. We want to make sure that team gets all the support they need and they can actually grow their revenue. And also ensure that we get those operating efficiencies within that acquisition. And we've been able to do that. The team have been, really open to change. So we've moved the iLink team within a quarter onto all our systems and processes, because they found it was far more efficient for them and it made their life easier, so they could focus on revenue generation. We're going to continue to grow, to work on more AI and technology, AI solutions, technology partners. And we want to be able to give, our clients more data points. We'll all keep focusing on making our business more efficient. So we'll be looking at new AI solutions that we can roll out to the business, and also enhancing what we provide, the solutions we give to our clients. Maintaining NPAT profitability is an absolute imperative for us. We want to continue to grow that to be a growth company. So we will continue with the same investment philosophy that we've had for the last 4 years. And we want to set ourselves up for beyond FY25. We've got a 3-year plan. We're very clear about the direction that we need to make as an organisation and all the milestones we need to make over that period of time. And we've got the right board in place to help support Martin and myself and the executive team to do that. So that's, I think, the final slide. Don't know if you want to finish that off.
Brilliant, Mel. Thank you very much, Dee. So look, in summary, we've had continual growth as business, as Mel says, consistent growth of the business. Really happy with that first NPAT profitability to then grow out on that. And then when we look forward, financial year 25, it's about bringing new solutions to the market so that we can cross-sell and upsell to our existing clients and also win new clients. And then it's about growing that market share that we have in the international arenas. So with that, I will hand back to David.
Thanks both for your insightful presentation and deep dive into the business, clearly providing some great insights into the work that's been done over the last 3 to 4 years to really get the business into the shape it needed to be in to grow forward and drive profitability moving forward. As I said at the beginning, we'll be holding a live Q&A session, which we'll move into now. As a reminder, you can submit your questions using the Q&A function on your screen, and I'll put these questions directly to Finola, Martin and Melinda as required. So let's just jump straight into it. This is probably a question for Martin or Melinda, so I'll let you two fight this one out. How are you using AI to refine the platform business, and what sort of investment is required for this, and can it be funded from operating cash flow?
So, starting with the end of it. So yes, all of our innovation is funded through operating cash flow. And as Mel talked about, within our current capex, it's about 2.2 million. And really, that's a case of saying, we've got 20 odd engineers dotted around the world in our development team, and those engineers are now being redirected from that internal work that we've having to be done over the last few years to now external innovation. So we don't have to hire new people. It's about those resources doing different type of work. And as I said, we've already seen new releases come out to clients. For us, the AI, as I said, it's 3 buckets. Number 1 bucket is internally, how we do reporting, how we analyze data, maybe some of our workflow systems. What can we use AI for that makes us better or faster or improves quality? So that's our first bucket, and we have a product team that looks at the 3 areas. The second bucket is looking at external clients, or externally looking at clients. So how can we roll out solutions to existing clients that makes their lives simpler and easier and faster and potentially cheaper, but still maintain high quality? How can we roll out solutions to win new clients as well? So again, we've got some people that head up our innovation team looking at what solutions are needed within the market. And some of those might be partnerships. Some of those might be where they've got successful solutions in other parts of the world, but are never going to launch in Southeast Asia or are never going to launch in Australia. So maybe we can partner with them launching their solutions in some of our markets. And then the third bucket is AI clients, AI companies as clients. So that's brand new revenue for us. And all of the, if you go to ChatGPT-4 today from OpenAI, or if you go to Gemini from Google, or whoever you use, they have to get their data from somewhere. And they can get their data by scraping information from Reddit or X or Meta or whatever else it is, social media, etc. And they can get really accurate data from real people. And we coined the phrase real data from real people. And so we become an important source for all of those large AI companies, which are actually called LLMs, and become an integral part of their growth. So those are the 3 buckets where we look at AI.
And in terms of recurring revenue, talk us through sort of what that looks like now, particularly from a platform point of view, and then what does it look like moving forward?
Yeah, so recurring revenue covers a few areas for us. So recurring revenue might be, we've got long-term contracts with clients, and might be multi-year contracts with clients, which can be reoccurring, which is reoccurring revenue, because that might be a monthly or weekly piece of work that we're doing for a few years. Then when we look at so that's could be managed service. So that's that team sitting in India and Philippines, but I've got long-term contracts with clients. Platform is then made up of several different revenue streams. So one revenue stream comes direct from clients. So that's where clients are linked directly to our systems, and they are system to system connectivity, and they are getting data for their systems and potentially for their clients. And that's API to API connectivity. And so, for example, we've got large clients such as Qualtrics, which is a big reporting company or a software company in our space. And so we have direct API links to them. And we have that's growing capacity for us. And we have a number of clients that now go directly to our system. So that's that API connectivity. The second bucket is audience builder clients. So again, we have direct links to people, as I talked about earlier, Flybys, Raise, News Corp, etc., etc. And we've got about 12 or so audience builder partnerships around the world. And that again is directly linking our clients, our client data to their systems, and they might be their loyalty scheme, their app, or whatever it is. And so again, that's platform delivery, doesn't take any human interaction. Insights Builder is the fourth area. So we've got a number of clients who use our DIY tool. And then the last area is audience intelligence. So that's where we gather all that information from our clients, from our consumers that clients access. Now, we saw a huge amount of growth, 102%, I think it was, 100% in financial year 24 of platform. And that was driven especially by large audience builder clients that have come on Shopback. We had a full year of them, more growth within Flybys as well as Sprive out of the UK. So I wouldn't expect platform to grow as strongly as it grew in financial year 24. But certainly the expectation is that it grows as a percentage of our revenue. And I think Finola's numbers were quite accurate of our expectations. And the more automated we can be, the more efficient we can be. And again, that's not just driven by us. Many of our clients are upping their technology. And it's not been a case of they haven't wanted to do it. It's been a case they haven't been able to link directly to our systems. But as we see innovation grow, and I talked about that earlier, and with the advent of AI, as we see our clients become more technically aware and technically have technical ability, we will see platform grow for us as a company.
Melinda, a question for you. When you look at the performance of the international peer group, do you think Pureprofile is winning market share from them?
Oh, absolutely. We know that we're taking market share in Australia, and we also know that we're taking market share outside of Australia. Just by the virtue, you can just see from the obviously the results that you can see within the peer group, whilst many of our peer group are actually going backwards. So their growth is declining. We have got a couple that are growing, but they're growing obviously to a single digit from that perspective. We also know just from, we're a small industry. We all know each other. And we just know from the feedback that we get from clients that we are winning business. Part of when we hire new team members and we invest in sales capability, quite often those team members are coming from one of the peer group. And they typically will come with clients, etc. So, and we make sure that what we do is we, create a great environment for our team members so that they want to come and work for Pureprofile. We actually hire pretty much all our team members through referrals. We have a lot of people within the industry that proactively come to us asking to work for us. And that makes sure that we have the best high quality sales team in all our jurisdictions that we operate in. And that allows us then to, really grow the share of the wallet that we get from each of those clients, whether they're based in Australia or anywhere else in the world. So, it's really been our strategy is to make sure that we hire amazing people, make sure that they give our clients an amazing service. And you just seem to, the clients stay with you and they'll give you a greater share of it. We've got that strategy down pat now.
I've just to add to that, I mean, I've just come back from 2 weeks in the US, which was 2 main areas. Number one, viewing possible partners to accelerate our launch in the US. So that could be data partners and as well as technology partners to accelerate that boots on the ground, but also looking at what products actually, because we've got this amazing distribution network of 13 countries for American companies who it's too complex to go internationally, what solutions could we launch to our client base externally from the US, and then also seeing clients. And I think it was 15 meetings in 7 cities and 9 flights in 2 weeks from LA right the way to New York and in the middle. And to answer your question, every single meeting started with congratulations to Pureprofile. And whether it was a client, whether it's potential partner, whether it was a distribution partner or even a competitor, I met with some, every single person was, how on earth are you guys doing it? It's amazing the traction that you've got, and well done to you and the team. So I'm hearing it all of the time in the market as well.
Final question, and it relates specifically to the UK market. We've seen a change of power from a political point of view with Labor coming in. Has there been any change in demand, and what's your sense of the broader economic environment there?
Yeah, that's a really good question. Yes, it's a really good question to ask. We're not asked it enough times. We're in 13 countries now, so we're able to firsthand see trends in markets, and that can be anything from bids to wins to payment time it's taking clients, decision making, seniority of company in organizations of people that are getting involved with clients, etc. And all of those are indicators of good times and challenging times. And to be honest, how I'm now seeing is Australia is an outlier. You know, as I said, I just came back from 2 weeks in the US. Without a doubt, the absolute positivity really turned a corner within the market and the economic cycle. They're talking about first interest rates cuts are going to happen. The UK, whilst the new government is ruffling feathers a little bit, let's say, the reality is, from a business standpoint, again, we're seeing that inflation has come down, interest rates are going to come down, there's business positivity, and so we're seeing increase in activity from clients, from prospects, bigger spend is going on internationally, and quicker decision making, everything that we see coming out of an economic cycle. Australia was late to the party. Right, we were late with our interest rate rises. We've been late, therefore, to get a lid on inflation, and Australia hasn't quite turned that corner that we're today seeing in the rest of the world. And it's great for us as an organisation that we have so many levers that we can pull with types of clients. It's geography, it's solutions that we offer. And so we can have one market slightly slower than another market. We can focus on other markets and pull those levers. So it's really good. But yeah, the reality is the rest of the world is coming out of the recession that we never called a recession, whereas Australia isn't quite there yet.
And business good in the UK?
Yeah, really good. And again, the advantage that we've got in the rest of the world is we've got a tiny market share. So if I'm winning a client today that has $50 in their wallet to spend, and yesterday they had $80, I don't know that yesterday they had $80. If I'm the incumbent, it's painful if they've gone from 80 to 50. But for me, thank you very much indeed. I'll take your $50 and let's deliver you a high quality solution. And so what we're finding is that bringing on new team members is particularly easy from competitors at the moment. They themselves bring clients, bring relationships with them, enable us to grow. Clients are looking for high quality solutions, and companies that are investing in that data solution, because it's the value and the importance of that data is magnified in that $1 million or £1 million decision that they're making. They need to understand their consumers. And when you look at competitors that have been struggling, the largest competitor in our space, Dynata, actually went into Chapter 11. And they went into Chapter 11 because they had $1.2 billion of debt that they had financed at about 0.5%, and they couldn't get it off at over 5%. So they need to go into Chapter 11 to restructure the debt. Well, guess what? Clients came to us, employees came to us, to say we need certainty, we need high quality delivery, and that's been a good positive for us. And you don't want to see that in any organisation. I used to head up data in various regions as well, so you don't want to see that. But we're leaning into that, and we're definitely seeing that clients wanting and needing to come to us.
Well, we have reached the conclusion of the Q&A section, and we have gone through all the questions that have come through. So thank you to each of you for answering the questions as they've come in. I'd like to thank Finola, Martin and Melinda for presenting today. I'd also like to thank each of the attendees for your participation in the webinar and engaging so proactively in the Q&A. We hope you found this webinar informative and valuable. We look forward to seeing you at our future events. And next week, Bird Dog Technology will be the focus, where we will do another deep dive into that company and give you an overview and analysis before hearing the company present. So until then, thank you to each of our presenters.
Thank you, David.